All right, let's dive into one of the most powerful concepts in all of trading, price action. We're going to forget about trying to predict the future with all those complicated delayed signals. Instead, we're going to learn how to read what the market is doing right now. And trust me, understanding this is absolutely fundamental.
Now that is a pretty bold statement, right? But it really sets the stage for why this stuff is so critical. Think about it. So many trading strategies are all about looking backward. But price action, well, that's what separates just reacting to the past from actually trading in the present. It's like learning to speak the market's language as it's happening.
So what's the deal with all those common indicators, like the MACD or the RSI? Well, here's the thing. They're lagging. They have to use past price data to spit out a signal. That means by the time you actually get the signal, the move might have already happened. Price action, on the other hand, is your live feed. It's pure, it's immediate, and it's telling you what's going on this very second.
Okay, let's get into our very first secret. And you might be surprised to hear this, but one of the most powerful clues on any chart is probably hiding in plain sight, right inside a single candlestick. It's all about learning to read its story.
This is the one. This is the candle you want to look for. A big, solid green candle with no wicks. None. Zero. This isn't just some random shape. It's practically screaming a very clear message about who is in complete control of the market. Let's break down what that message actually is.
So what is that message? Well, this candle tells us that buyers found a price they absolutely loved, and they just rushed in with overwhelming force. The buying pressure was so insane that sellers couldn't even make a dent, which is why there are no wicks. It's a huge bullish sign, and it actually creates a powerful memory in the market that we can use later.
And here's the crucial part, the takeaway. That price level, where all that buying went down, that spot is now a powerful memory. You should literally go and mark that spot on your chart as a new support level. Why? Because the next time the price comes back down to that zone, there's a really high chance that those same buyers are going to step in and defend their positions.
All right, let's move on to secret number 2. This one is all about a fundamental law of, well, let's call it market physics. I want you to picture a rubber band. You can stretch it and stretch it and stretch it, but what does it always do eventually? It has to snap back. The fancy technical term for this is mean reversion. It might sound a little complex, but the idea is incredibly simple. Prices can't just run up or down forever without taking a breath. Over time, they have this natural pullback toward their average price, just like that rubber band snapping back into shape.
So how do we actually use this? It's all about looking for the extremes. If you see the price take a huge nosedive, stretching way below its moving average, that's a potential sign that a snapback, a buying opportunity, could be right around the corner. And on the flip side, if the price just rockets sky high, way above its average, you can start to expect a pullback. It's about using the market's natural rhythm to your advantage.
Okay, time for secret number 3, and this is all about momentum. See, it's not just about which direction the price is headed, it's about how fast it's getting there. The acceleration of the market can tell you a whole lot about what's coming next. So, what is momentum really? Just think of it like the market's gas pedal. Is the price just kind of cruising along slowly and steadily, or did somebody just floor it? Understanding that change in speed is a massive clue about the real strength of the buyers or sellers. And this slide shows it perfectly. On the left, you've got the turtle, a slow, sleepy, gradual climb. But over on the right, whoa, you've got the rocket, a sharp, aggressive blast-off. That shift from turtle to rocket, that is the signal you're looking for. The market is telling you that the feeling behind the move has totally changed. So what's the psychology here? Well, that sudden acceleration means way more buyers are jumping on board. They're getting confident, and you know what? That confidence is contagious. This often happens right before an even bigger, more explosive move. So spotting this kick in momentum is a key sign that a trend is healthy and it probably has more room to run. And now for our final secret. This one's a little more technical, but it's incredibly powerful, so stick with me. We're going to start looking at pullbacks, not as scary reversals, but as a test. It's a way for us to measure the true health and strength of a trend. First up, what even is a pullback? Well, markets don't move in perfectly straight lines. They move up, they take a breath, and then they move up again. That little breath is a pullback. It's a totally natural and healthy part of any trend, and it's usually just caused by some early traders taking a little profit. But here's the key. Not all pullbacks are created equal. A shallow, weak pullback during an uptrend?
That is fantastic news. It's like the market is barely even tapping the brakes. It shows the buyers are still firmly in control. A deep, strong pullback, though, that's a warning sign. It suggests sellers are getting aggressive, and the trend might be running out of gas.
So this brings us to the big question, right? How can we tell the difference between a weak and a strong pullback with some actual precision, instead of just, guessing? Luckily for us, there's a tool that helps us do exactly that.
The tool we're going to use is called Fibonacci retracement. Now don't let the name intimidate you. We're going to keep this super simple. All you do is select the tool, and for an uptrend, you draw it from the lowest low of the move all the way up to the highest high. Then we just simplify the settings a bit. This gives us a crystal clear framework for measuring that pullback.
And this right here, this brings us to the golden rule. It is so simple. If the price pulls back, but it finds support above that first key level, the 0.382 line, we call that a weak pullback. And that's a very bullish sign. But if it breaks below that level, that's a strong pullback. And that's our warning that the trend might be in trouble.
So we've covered 4 really powerful secrets today. But the real secret, the one that ties this whole thing together, is that their true power doesn't come from using them alone. It's all about combining them.
So let's just recap your new toolkit here. You now know how to read the story in a candle, you know how to watch for that mean reversion snapback, you know how to gauge momentum, and you know how to scientifically test the strength of a pullback. Each one of these is a piece of the puzzle. And this quote really says it all. Trying to use just one of these ideas by itself, yeah, your win rate probably isn't going to be very high. But when you start to layer them together, when they all start to line up and tell you the exact same story, that's when they can become extremely powerful.
Just picture this. Imagine you see that big wickless candle, signaling huge momentum. At the same time, you notice the price is stretched really far from its average, so you know a snapback is likely. And then the market pulls back, but it's a weak one, holding strong above that key Fibonacci level. Do you see how those signals all confirm each other? That is when you have a powerful, high-probability setup.
So we're going to leave you with this. You now have a framework for actually listening to the market. The chart isn't just a bunch of random lines anymore. It's a story, and it's unfolding in real time. So the only question left is, now that you have the tools to read it, what story is the chart telling you?